Good morning, everyone. Apologies for a short delay today as I was awaiting some attendees to connect. I think now we are all inside and let's start. This is the live daily outlook for the markets for Thursday, 29th of September 2011. The main headline today is Germans voting on Euro Rescue Fund to basically set the new stage for new anti-crisis steps. German lawmakers are set to back an expansion of the Euro area rescue fund firepower as European officials tend to look at what next steps might be needed to stem the current debt crisis. The plan before the lower house in Berlin today would allow the fund to buy bonds and distressed states and offer emergency loans to governments, raising Germany's guarantees to 211 billion euros from originally 123 billion euros. The lawmakers are starting today. I think they already started at 11 o'clock Berlin time, so it's 1 hour ago they started, as government officials weigh further measures to bolster Greece and stem investor concerns that helped end the biggest three-day rally in 16 months for European stocks. Now this will be the positive outlook, the positive expectations. Expectations of a positive result from the Germans voting is actually pushing the markets higher this morning after initial losses yesterday when the euro dropped sterling and the crude oil actually registered the highest drop from 2008. Some more, I would say, depressive news come from the Bloomberg's poll that actually asking about view of the Europe's future in the coming 12 months, and the global investors anticipated that Europe debt crisis leading to an economic slump, a financial meltdown and social unrest in the next year, with the 72% predicting a country abandoning the euro as a shared currency within 5 years. About 3/4 of those questioned this week said that the euro area economy will fall into recession during the next 12 months, and 53% said turmoil will worsen in the banking sector laden with the government bonds, according to the quarterly global poll of 1,031 investors, analysts and traders who are actually Bloomberg's subscribers. More than a third of participants also said that deteriorating European debt will derail the world economy over the next year, with the pessimism highlighting the pressure European policymakers face as they try to fix their 18-month sovereign crisis. Stocks also tumbled last week into their first bear market in 2 years, and international financial chiefs, including U.S. Treasury Secretary Geithner, urged the European leaders to intensify their rescue efforts. So basically, not good news at all. Some positive came this morning. The negative outlook, the negative result from German unemployment that declined for a 27th month. This is the economic indicator released this morning, saying that German unemployment declined more than economists forecast in September. And this suggests that the labor market in Europe's largest economy is weathering the region's worsening debt crisis. The number of people out of work fell seasonably adjusted 26,000 to 2.92 million. And the economists forecasted a drop of 8,000. So another disappointing news. However, let's take a brief look to today's calendar after the German's unemployment that already released. The coming news today, the net lending from UK and mortgage approvals are due at for 11:30. Pardon, this is at 8:30 GMT. 8:30 GMT, and the forecast for mortgage approvals is slightly higher from the previous release at 50,000. While the net lending to individuals is expected to slightly drop to 0.8%. However, the key events of today are weekly jobless claims from US due at 12:30 GMT that are expected slightly to drop to 420,000 from the last week's 423,000. And another important release today is the US final GDP quarterly. Forecast is 1.2% versus the previous quarter at 1%, and the last one, the pending home sales from US due at 14:00 GMT, expected to fall further. Minus 1.7% is today's forecast versus previous month release at minus 1.3%. Let's now take a look at the markets and see the euro, as we can see on the hourly chart, after breaking off above previous high at 136.67, extended gains through the main trendline resistance. The trend line drawn from 139.35 through 137.96, and the trend line was taken out at 136.43. However, the gains stalled on approach to our next significant barrier at 137. 136.89 was seen yesterday, ahead of significant reversal. The risky point was a loss of initial support at 135.40 and possible attack at strong support at double bottom at 134.80 zone. However, the support was found at 135.18 in early hours of today's trading, and the fresh push higher regained the trend line, and currently is attacking at 136.89. We are just a few ticks below it, with break here required to open way for test of our initial and strong resistance at 138.00, 137.96. Actually, it's the high of 21st of September. Fibonacci levels come as follows. We have the coming one above 137 is 137.15, which is 61.8% retracement of the move from 139.35 down to 133.61, with break here to expose immediately 138 level. However, important to mention that the broader picture's outlook on the euro-dollar is still firmly bearish, and basically at this point a regain of 139.35 is required to improve the current outlook, while 140 zone along with the 200 days moving average break above these levels would signal a return back to bulls. Meantime, the bears remain continue to dominate on the bigger picture of euro-dollar. Sterling, quite similar situation with euro after initial rejection to clear at 157 zone, which is the part of a very strong resistance at 157, 157.55, which is the low of the previous last week's lower gap opening. Extended triggered the reversal that broke below the trend line, main trend line support down from 136.28, and the losses were extended down to 155.42, just above 155.25, our initial support, and fresh strength now is back in play. A clearance of the broken trend line now is attacking the 157 zone, above which opens 157.55 and then 158.00. At this point also the levels of retracement from the down leg from 158.67 down to 153.26, clear 61.8 Fibonacci retracement has been cleared as the initially gains were stuck, actually unable to sustain gains above this level. Now we have a break again higher with clearance of 157. I mean clear break to resume higher 158 and then 157, 50, 45, 55 is our next barrier, and then we have 158, possible attack to 158.67, above which would signal some stronger recovery. Also on the cable, the wider picture outlook is still firmly bearish, and the daily 20 days moving average at 157.64 is the next obstacle, along with the 157.45-55 resistance zone. 200 days moving average at 161.26 actually would be the break point, and break above this level to signal return to the positive tone and the possible reversal back towards 165-166 zone, the area of the previous high. Dollar yen, again, nothing much to say. The pair has again narrowed the range, moving within some 20-30 ticks range from yesterday's, after yesterday's, 2 days ago, pardon, upside attempt failure under 77, which is our main barrier at this point. And currently, the support was found at 76.30. Currently, the pair is moving in the narrow range. Only to say that main range between 76 and 77 has to be cleared either way to establish the fresh trend, as the pair remains within this range for past over 1.5 months. And the upside clearance of 77, basically 78, then to signal stronger recovery. On the downside, 76 and 75.93 are the main supports. Again, to repeat, just the possible intervention of the of the Bank of Japan is still pending, and it's not ruled out at this point, as Japanese officials are trying to support their economy with further strength of the yen. Is not seen suitable for the economy at this point. So the possible reaction is expected at any time when they decide to jump in and protect the market, to protect their currency. So I would say it's more support from the downside, actually preventing the further losses of dollar yen. The dollar Swiss is currently ranging after dipping below the main support at 90 and retesting previous high at 89.26. However, the 90 zone is now acting as a resistance, and the gains were capped here, and currently fresh weakness. Today's slide briefly dropped below 89.26, which would likely allow for the further correction of the broader uptrend from 70.67 record low. The hourly studies are breaking below the midlines and pointing lower, so we might see some further action lower. Significant area to watch is around 88, where the 200 days moving average currently stands, and basically loss of this level would significantly dent the current strong bull trend of dollar Swiss, and open way for deeper correction, with the next level to watch at 86.46, which is the low of 15th of September. Holding above 88.00 keeps the immediate bull tone in play, and for possible fresh attack higher, and 91.80, 92.00 are initial targets on the upside. Commodities, let's just first take a look on the daily. It seems that the recovery attempt of yellow metal is running out of steam, as the gains were capped at 1676, which is the high of 27th of September, and the 90 days moving average on daily chart is currently capping the upside. However, the downside remains well protected for now by 200 days moving average, and while holding above here, which is around 1530 currently, keeps the scope for a possible further bounce higher with clearance of 1670-80 zone required to extend higher, and where we have the next barrier at 1700, which was our previous strong support. On the short term, the gold is currently trading in the recovery mode. However, the upside was mainly limited by 20 days moving average, where the market is currently attempting to break. The hourly studies, near-term studies, are well below their midlines, although pointing higher, but still signaling further weakness. So while holding above our initial barrier at 1676, the focus remains on the downside for a possible retest of today's low at 1582, and the loss of this level to refocus 1532, the low of 26th of September. Crude oil was in sharp down move yesterday, after the gains were initially capped at 84.60-75 zone, with the strong fall dipping down to 79.63, the low of this morning in the early hours of the Asian session. However, some recovery was triggered by positive expectations from the Germans today's voting, and that would be directly affecting the further and stronger recovery of the European Eurozone economy, and furthermore the increased demand for energy. So this was the initial support for the crude oil. On hourly chart, we can see that studies the regained momentum actually signaling some stronger gains, especially with the break above 20 days, hourly 20 days moving average. However, this indicator is still pointing to the downside, so we might see some negative impact on this. On the 4-hour chart, the situation looks quite similar. The brief break above 20 days moving average and the current attack at 9 days moving average might be signaling some stronger recovery, but break of 20 days below 14 days moving average is now currently capping the current gains. On the upside, we need to see a gain of minimum 84.75 in order to resume the near-term recovery from 77.12 and open way for next levels at 85 zone, which is the stronger double bottom and stronger resistance. Failure above to clear initial resistance at 84.75 would just confirm the lower top and the likely fresh leg lower, with the loss of initial support at 79.63 to refocus 77.12.